A very warm welcome to Audit Assurance of TK. So today we're going to learn one of the most important concepts, okay? And this is not important only in terms of exam perspective, but it is also important when we do audit actually, or even in your interviews after your CA final exam. So let's learn it conceptually rather than learning it. This is what it means in audit, okay? And the concept which we are going to learn today is nothing other than assertions. So, what is assertion? That's the very first question we have, right? We hear this assertion everywhere assertions, assertions, assertions. But what does assertion actually mean? Let's take an example of an FS. I have this FS being, which I got it from the website, okay? And here we have the FS as at 31st March 2024. We have the balance sheet, which says that the property, plant, and equipment is 903.04 lakhs. Goodwill on consolidation is 25.34. So we have so many financial line items in both balance sheet, P&L, statement of changes in equity, cash flow statement, and we also have disclosures down there. Now, coming here, try to answer this question. What is management trying to do here by giving an FS? What is management trying to do? Aren't they representing that property, plant, and equipment is 903.04 lakhs? Aren't they representing other intangible asset is 37.16 lakh? Aren't they representing that the total comprehensive income attributable to the owners of the holding company is 1,131.42 lakhs? And similarly for each and every financial line item, aren't they representing? So, assertions are nothing other than representations by management. Okay, so what are those? They are representations by management. And these representations are in the form of FS. Okay, so we are telling that these representations are embodied in FS. And when we say assertions, we categorize this into explicit, implicit, and both these implicit and explicit are being again categorized into positive and negative. First, let us understand what does implicit assertion mean. Let's say we have property, plant, and equipment, right? Property, plant, and equipment, the management says that the total property, plant, and equipment as on 31st March 2024 is 903.04 lakhs. So, what are they trying to represent here? They're trying to represent that property, plant, and equipment is in existence worth of 903.04 lakhs. This is the value of our property, plant, and equipment, right? So, this is being implicitly stated by the management. There is nowhere explicitly stated specifically that property, plant, and equipment's value is 903.04 lakhs. And it is in existence. It is valid currently. It is being held, that is the ownership, the rights is with the company only. No way it's being specifically stated, but rather it is being implicitly represented by management. So this is what we call as implicit assertion. Okay, now coming to explicit assertion, let's take an example of contingent liability. Give me a moment, I'll take that example. Yes, we have the contingent liabilities, bank guarantee is 1,285.20. For example, let's say this company states that there are no contingent liability. Okay, here it's specifically stating, right, there is no contingent liability. Similar to that, here it's specifically stating, right, the contingent liability of bank guarantees 1,285.20 lakhs is what is there in the company, right? So this is known as explicit assertion. Okay, so we have explicit and implicit. To put it just very simply, implicit is something which is not stated specifically, but rather explicit is something which is stated specifically that this is the contingent liability. There are no contingent liability in the company, which is stated explicitly. Okay, now coming to the further categorization, which is positive and negative. Let's take for first explicit, positive, negative. Okay, let's take the example of contingent liability itself. Here in contingent liability for this company, we have the contingent liability bank guarantee of 1285.20. This is positive explicit assertion. But in case if this company does not have any contingent liability at all, what does it say? So then there are no contingent liabilities. That will be negative explicit assertion. Okay. Now, moving on to implicit positive and negative assertion, let's take the balance sheet. Yes, we saw right in balance sheet, we had property, plant, and equipment value of 903.04 lakhs. Right? We've already discussed that all these are explicit or implicit assertion. Which type of assertions are these? These are implicit assertions, is what we discussed. Since it provides a value, it says that there is 903.04 lakhs. This property, plant, and equipment is there, right? This is known as positive implicit assertion. Now, you see here, for the intangible asset under development, we have the value as zero, right? This is negative implicit assertion. Okay, so assertions are nothing, they are representations by management and which is embodied in the form of FS. And this could be either explicit or implicit. And once again, the explicit and implicit are being categorized further into positive and negative assertion. Okay. And when we say that we have this, let's say, the explicit assertions, these are being particularly made so that the readers are not provided with incomplete picture. For example, let's say this company did not have any contingent liability at all. And if the company has not provided this disclosure that there are no contingent liabilities, then for sure the users of FS, when they see this FS and when they read through the FS, they will have a question, right? Does this company have contingent liability? Or haven't they disclosed? Or haven't they not disclosed it? Or what actually happened here? So there will be an incomplete picture, right? So that's why explicit assertions are being made. Okay. Now, moving on to the assertions, we have balance sheet, right? Similarly, we have profit and loss. We also have disclosures. So, for each and every elements that is for balance sheet, profit and loss, and disclosure, we have set of assertions. Okay. So, first, what do we call them? It's known as A, B, C, D. A, B is nothing other than account balances. C is nothing other than classes of transaction. And D is disclosure and presentation. Okay. Account balances, once again, in simple terms to put it, it is balance sheet. Class of transaction is P&L. And of course, disclosure and presentation is disclosure. Okay. For balance sheet, we have 4 assertions. For P&L, that is for class of transactions, we have 5 assertions. For disclosure, we have 4 assertions. Let's see these assertions one by one for each and every elements. Number 1 is account balances, which is AB. We have already discussed how many types of assertions are there in this? 4 assertions. Yes. The very first assertion is existence. Let's take the example of property, plant, and equipment itself. Okay. We saw that the property, plant, and equipment is 903.04 lakhs. Okay. So by this assertion, what it means is that all these 903.04 lakhs of PPE are actually in existence. It's not something bogus. Okay. Number two, rights and obligation. Okay. What does this mean? The 903.04 lakhs of PPE's rights is with the company only. Okay. The entity, that is the company, is holding rights on it. Yes. Number three is completeness. Okay. Let's explain this with an example. Let's say there was a property, that is a machinery, which was put to use and it is ready to use itself as on 29 29 March 2024. Okay. But this entire accounting process, it takes a week for being accounted. So they accounted it in the books only on 3rd March 2024. Now tell me whether this should have been in the property, plant, and equipment as on 31st March 2024 or 2025. It should be in 2024 itself, right? So that is what we mean in this assertion completeness. What we mean is that all the assets that should have been recorded are actually recorded. Okay. And last one is valuation and allocation. All of us have learned in the A's. What have we learned? The property, plant, and equipment. In case if there's going to be a directly attributable cost, it should have been capitalized. Now let's say the machinery is directly attributable cost or being expensed off only, and they are not included in the property, plant, and equipment. Then is it valued correctly? Is it included in appropriate amounts? No, right? So that's what we mean in this assertion. So for AB, that is for account balances, we have four assertions, which is existence, rights and obligation, completeness, valuation and allocation. Can we move on to the next one, which is C, that is P&L. How many assertions did we discuss? We had 5 assertions. Okay. Shall we take the example of revenue from operations here? Yes, we can take revenue from operation. Number 1 is occurrence. Okay. So what was the total revenue from operation? It is 46.14 lakhs. Yes. So all these 46.4 lakhs of revenue from operations, that is the sales, is actually occurred. And it's not something bogus or something which has not been occurred and the company is accounted for it. Okay. Number 2 is accuracy, which is nothing other than it should have been recorded at appropriate amounts. Okay. Number 3 is completeness. That is all this revenue from operation, whatever should have been accounted is accounted. 4th one is cutoff. Let's take an example here. Let's say the company as this company, okay, it has started to deliver the goods as on 29 March 2024. And these goods have reached the customer's factory only on 3rd April 2024. And what is the terms of sale is that only when it reaches the customer's location, the rights in these goods will be transferred. Okay. In this case, just tell me whether sale has actually occurred on 3rd March 2024 or 29 March 2024. It is 3rd March 2024, right? So then the revenue should have been accounted for the year ending 31st March 2025. Right? So that's what we say as cutoff. What we mean here is it should have been accounted in the correct accounting period. Okay. And last one is classification. All of us would have learned this in our accounts itself, that let's say we have an interest income. Where this interest income should have been accounted? It should be accounted in other income, right? Shall it be accounted in revenue from operations? No. So what we mean here is it should have been accounted in the correct or proper accounts. The other income, that is that interest from interest income, should have not been accounted in revenue from operations. So that's what we mean in these assertions. So for class of transactions, we have five assertions, which is occurrence, accuracy, completeness, cutoff, classification. Can we move on to the next one? So we have covered A, B, C. The last one, which is one is pending, is D, which is disclosure and presentation. Here we have already discussed that we have four assertions. Let's take an example from the FS, okay? Give me a moment, I'll take that example. Yes. Now we have the disclosure here, which is disclosure in accordance with related parties. To simply put it as, it is a related party disclosure, okay? Let's first say the number one assertion is classification and understandability. Okay, let's say, for example, here they have stated all the related parties and specifically they are categorized. These are the key managerial personnel. These are the entities which are significantly influenced or controlled by key managerial personnel and their relatives. And the third one, this is the relatives of key managerial persons. So they're stating it clearly, they're putting into several categorization, right? Why don't they just say list of related parties and give all these related parties list alone without this categorization? Then it will be difficult to understand, right? So this is what we are saying. So the presentation disclosure should be clear, should be classified so that it could be understood, right? That is number one. Number two is accuracy. Now, as you can see here, we have the transactions with the related parties during the year, right? So all these amounts, let's say we have the remuneration to KMP. Mr. Virendra Sagavi, we have 168 lakhs. All these amounts, whatever is being provided here, should be accurate. That is, it should be appropriately recorded. Okay. Third one is completeness. That is, everything, whatever should have been disclosed, should have been disclosed. To simply put it, in accounting standards, we have learned that irrespective of whether the transactions have occurred during the year or not, the related party list should be provided, irrespective of whether you have entered into a transaction with that related party. This is also one of the examples for the completeness assertion. Okay. Now moving on to the fourth one, it is valuation and accuracy. Okay. So all these amounts are provided at fair amounts. That is, they are provided as appropriate amounts, is what we mean here. So what it is? It is disclosed fairly and appropriate amounts. Okay. Which we have already covered here, which is accuracy, right? So we also include validation and accuracy. So this will be covered in second one itself. So it means we have the fourth one pending, which is occurrence, rights, and obligation. Okay. So what do we mean by this? What are the transactions that they have disclosed here? All these have been occurred. And we can also see here, there we are provided, the entity is provided what are the amounts outstanding. So all these are either we are obliged to pay to the related parties, or in case the related parties are supposed to, let's say it is a receivable for the entity, then we have the rights on it. So that's what we mean as occurrence, rights, and obligation. Okay, so we cover the assertions for disclosure also, that is for D, which is classification and understandability, completeness, valuation and accuracy, and the last one is accuracy, rights, and obligation. Okay, now moving on. Now let's see in our perspective, that is the auditor's perspective. What are we as auditors going to use these assertions for? Okay, the important one is to consider different types of potential misstatements. That is where all there could be possibilities of misstatements. Okay, let's say we discussed here, right? Irrespective of whether any transactions have occurred or not, all the related parties list should be provided. There could be a potential misstatement that the related party is not included because the company or the entity, the management who has prepared the FS, they would have thought so that we have not entered into any transactions during the year at all. And why should we provide that in the list of related party? So this is a possible, it is a potential misstatement, right? Similarly, for each and every assertion, the auditor will consider the different types of potential misstatement. Okay, so this is utilized for that. And number two is, we'll have a question now. Are we giving an opinion only for this assertion then? Are we providing opinion only for the specific assertions here? No, right? So when we say FS, it's not only specific assertions. Let's say for all these disclosures, we have different assertions, which you have discussed just now. For all the balance sheet financial line item, for all the P&L financial line item, we have specific assertion. So does this FS only have these components? No, right? But rather it's providing a overall representation. Okay, so we as auditors, our auditor's opinion will be on FS as whole and not the specific assertions. So how will the auditors will form an opinion is that number one is, first we will obtain audit evidence on all these specific assertions. We'll make inquiries. Okay. Number two is, we will, what we'll do here? We will form individual judgments on all these specific assertions. For example, let's say first we have this property, plant, and equipment, right? We will first form a specific judgment whether this existence is it showing a true and fair view, rights and obligations show and true and fair view, completeness is it showing a true and fair view. Similarly, for valuation allocation, is it showing a true and fair view? We will form specific judgments on these assertions, and then based on the specific judgments, that is these individual judgments for each and every assertion, we will form judgment on FS as a whole. Okay, so as auditors, we are utilizing, that is, we are using these assertions to consider different types of potential misstatements. And moving forward, how will they form an opinion will be the next question. For that, we will first form individual judgments on the specific assertions, and then we will form the judgment on the whole FS. Because we are not providing opinion on the specific assertions, but rather we are providing we are providing opinion on the FS as a whole. Okay, so maybe I'll also upload these notes which we have here, which we have already covered in our discussions on what is assertions. It is nothing other than representation by management, could be either explicit or implicit. They're embodied in FS. It's used by the auditors to consider different types of potential misstatement. And we also have the assertions for A, B, for class of transactions, which is C, for presentation disclosure, which is D. And then we also have the additional notes. And when we say FS, we have specific assertions plus overall representation. And when we just look at FS, we do not show only components, but it also represents something as a whole. So the auditor's opinion is on FS as a whole, that is overall representation. And when we have this question like how actually auditors form opinion by inquiring on the specific assertions, and they'll form individual judgments on the specific assertions, and the judgment would be formed for FS as a whole. So that's it with our today's video. I hope all of you would have understood this. If any doubts, please ping in the comments below. And yes, we look at another important concept in our next video. Stay tuned. Bye bye.